Good evening everyone and welcome to Admiral Markets webinar. Chris and I today will present you how to overcome the psychology of a losing trader. And trading is business where you definitely need to be ready for a risk. And a lot of times during our training we will encounter some problems that are not related so much to trading, but more on our psychology. I personally know some traders that are very, very good, as traders, but they are missing that final part, the final link, and it's called psychology. And even though if you're trading, if you're not that experienced in trading and you don't know how to recognize a good setup, even then if your psychology is good, it's a path for success, definitely. It's much more important that you have a good psychology than that you are actually a perfect trader. Now the best traders are those who can combine the best of both. So best traders are usually people who know a lot about Forex. They know how to analyze, where to put entries, but also they know how big the risk should be, how to manage with exit points and so on. So it's a bit of complicated if you're a new trader, but definitely taking best parts from both of those trading types, if you combine it, you can become profitable. Well, it's not just a coincidence that trading companies and trading firms have the team of members. A member of a team is a trader, another member is analyst, then the third member is working within the risk department. So it's totally diversified company when you have three different types of people working for the same goal, and that goal is to make profits. And it's a good thing because well, it's very, very hard, guys, to manage everything. That is why when Chris and I are approached by many people and they ask us, okay, how come that when did you become profitable? We always say it took some time, and well, we learned on our mistakes and we paid for our mistakes. We didn't pay like, let's say, with demo accounts only. We also paid with live trading, and unless you make a good and nice substantial loss on your live account, you simply cannot comprehend what it means to have a good psychology and to cope with a proper risk. Before we begin with the actual webinar, risk disclaimer explaining that CFDs and Forex trading are leveraged products and can result in losses that exceed your deposits. And this presentation and accompanying video is for information and education purposes only. So this video is not part of the .co.uk website, but the globalnews.com website. Okay, so agenda: loss aversion, revenge trading, and coping with a loss. Okay, this is what we will be dealing with today. First, we will start with loss aversion. Definitely, guys, loss aversion is a human emotion. We might say that it belongs to human emotions, but also it belongs to a human tendency. I may say that it's a natural human tendency, and definitely it can have a strong impact on your account if you don't know how to manage. This is a psychology issue. This is, as I say, a lot of traders that I know, they're simply good traders, but they don't know how to deal with losses. It doesn't qualify them to be bad traders because they don't know how to deal, but their psychology is bad. So they simply are too much gamblers in their nature. Although they know a lot about analysis, where to place entries, great things, but when they start to lose, that's the point, when they start to lose heavily. That is because loss aversion. Dealing with loss aversion is very hard job. Very hard job, guys. Loss aversion, by definition, is simply an unwillingness to accept a loss once your trade is closed in a losing position. And you probably close your trade when you see that your account is going down, But sometimes even then, when you see that your account is going bad and it's turning to a big loser, when you simply decide to hold and trade and let the loss grow, because you have the hope that by giving the trade more room, not respecting a stop loss, that it will eventually turn around in your favor. It's very hard job to cope with losses, and the biggest problem is that losses probably will easily grow. I said losses can easily grow, but most of the time is that losses do easily grow. Really, they almost all the time they easily grow, making up for even more losses. That is caused by trading plan deviation. And let's say that if you know that your method can produce 60% or 70% of profitable trades, well, then just an example, your method produces a certain amount of profitability over each month of trading. But the problem is that once you're in loss, you don't accept it. It doesn't matter. You can have 90% of accuracy, but that 10% is what it matters. Because if you can't accept that you will have a loss from time to time, it doesn't matter. You can have 90% of successful positions, and that 10% of losses will wipe your account. Now imagine, guys, and think about it. Think deeper and deeper in your, go just deeper and deeper into your own head. And I'm sure that you will remember that these things actually happened. I know that because, simply put, I've been receiving a lot of emails from different traders asking me how to actually, what to do once they're in losing position. For example, some people from Forex Factory sent me an email and they told me that they're like 200, 300 pips in a loss. And I asked them, okay, what is your stop loss? And they told me, we don't have a stop loss. I mean, really, I don't know what to say when a person tells me that he or she doesn't have a stop loss. The only thing maybe is, okay, you don't have a stop loss, but you have a mental stop, right? So once you lose 30% of your account, or 40, I don't know, you will actually close your trade, right? But it doesn't happen. Usually it doesn't happen. As I said, losses will easily grow with losses. It's simply a streak, a losing streak. And it's also connected to a losing spiral that we also talked about a lot of times. Spiral of human emotions. It has definitely connections to human psychology. Definitely. It's not about the system, it's not about the method, because your system and your method is it just gives you, well, the possibility to trade, right? Because when you enter the position, you're no longer in control, guys, except that you can control the risk. You can scale in, scale out, you can put stop loss to break even, you can do whatever you want, but we are all different. That is why I always state we can trade the same system, but every single of us will have different result. That's because our psychology is different. Andy, you have a good point. Andy saying that it's like climbing a big cliff face with no safety equipment. And it's particularly true, very true, because you don't have a plan B. You don't know what to do. Guys, it's a bad thing. I went through it. I haven't always been profitable trader. I haven't always make nice big wins. It was a hard job for me. Literally, I was trying to make something out of this trading for a long time, until I realized that the problem is actually psychology. It's not that you want to make a profitable position, but one loss can, well, it can basically kill your account. So that is why you need to avoid the feeling of helplessness and start trading like professionals do. I will always compare trading with basically what professionals do, what banks do, and let me tell you that even big banks are also not profitable traders. Even people who trade with big banks, it doesn't mean that they will be profitable traders. You need to know it. So that is why you definitely need to accept the fact that you need to deal with you and yourself only if you start to lose a lot, guys. These are, let's say, we will use some examples. This is an example. Let's say that we will fear a loss. Let's say that we suffered a $500 loss. But think about it. We fear loss because our brain simply does not assign the same weight to a 500 loss as it does to a $500 gain. Okay? Guys, it's simply, think about it. Think about it in your life. Not having a relationship with someone isn't as painful as having someone and then losing them. It's very, very sad feeling, very bad feeling. Fear of loss and the actual loss is much more pronounced than its gain. If you, let's say, win a $500 on lottery, let's say, it simply does not equate to the frustration of opening your wallet and realizing that you lost $500 that you needed to pay for something. Simply put, our brain will not assign the same weight to winners and losers. I know that there was some study of Kahneman and Tversky, and they concluded that our brain assigns around 2.5 times the weight to a loss as it does to a gain. That is, well, you know, it's a bit of a bad feeling, and you want to make it up. You want to make up for it. And how you make up for it, guys? You know how you make up, right? Very easy. You want to gamble. Simply put, you want to gamble. Why not, right? Usually you will double your position, and I think that it's actually that is the time when you start to lose. You end up with doubling your position, and that is the time when you start to lose. We don't like losing. Okay, it's normal. I already explained. But definitely, then we are gamblers. So you need to decide whether to be a gambler or a trader. Gambling is easy in Forex market. Lose a position, then double your risk size, and hope that your next trade will go in profit. It's usually like that. I mean, it does not need to follow the same pattern, but it's usually like that. You think that you will make profit by simply doubling your position size, and it's a good thing if you make it up, right? But now we will see that it's not a good thing, guys. I know it's good in your heads, but definitely it's not good for your practice. It will not make you a good trader. You just had a luck with that particular trade, and next time you will lose, probably. So doubling the risk, non-stop trading, opening longs, then shorts, long, short on the same pair. You know what is most dangerous? Most dangerous thing is when you have the range and you go along here, but you didn't take profit, and then it goes down and you close your long and you open a short. Then that short goes 2 pips here, and then it goes long again. Okay, you cut it here and open another trade here. It goes 2 pips there. ranging market or such so-called EMA spiral that looks like this. This is the most dangerous thing. EMA spiral and definitely ranging market. Guys, it's the most dangerous thing. You can't see anything. This is what I charted. I will chart it again, no problem. So you have a range, right? And then the market goes like this. So you open your trade here and you didn't close it there. The market drops, then when it comes here, you close your long and you open your short. It goes 2 pips in your favor, but then again, market goes up, and instead of taking profits, but you want to make up for this loss, you don't take profits, right? Well, market just goes to here and start dropping again. Now, instead of taking profits here, you didn't accept that you should have taken profits here because you didn't make up for the loss and you desperately wanted to make up for the loss. But what happens here? You again open a short trade, then you didn't take profit here, the market goes like this. This is the path to lose your account. And with this practice, you might lose the account that has been set up for gain for a long time. Very similar to EMA spiral, exponential or MA spiral, moving average. Signals that are given like DNA spiral will usually be losses. Okay? This is the trap, guys. This is totally logical and that is totally ineffective, and it will lead you to the trap. The trap means that even though, guys, if once in a while you can make up for profit because market went up and you actually double your position size and you ended up with even more that you originally went for, then next time this will not happen. So you will have a false hope of price of that you made a good decision, and that is actually a very bad thing, because if you did it, the odds are that next time you will lose it. It's a trap. Thinking that you made a good decision just because you revenge your trade and you made it up with doubling your position size is a trap. It's a bad thing to do. Believe me, guys, it's a very, very bad thing to do. It's very hard to overcome. Definitely very hard to overcome, because you need to stay strong. If you try to actually surrender yourself to that emotional moment, you will not see the correct plan that can make you a great trader. During Second World War, there were great generals in both sides, in German side and in Alliance side. Do you really think that even, let's say that German was a losing side and they were a losing side, in Second World War, but do you really think that even though if they were losing, they didn't have some backup plan? Even losers, guys, need to have a backup plan. You need to just to tell yourself what to do if you start to lose much, if you can't cope with losses. What is the next thing you will do? Will you cry? Well, it doesn't lead you anywhere, right? Will you shake? Will you shiver? Will you drink? It will not give you any satisfaction. You need to think about lowering your risk. So if you traded with 2, 3, 5%, double, half your risk. Try to lower your risk. If you're in a good profit, then if you're ready, try to risk only profits. Don't risk equity. You need to tell to yourself, did you follow your plan, guys? Did you follow your plan? One of the biggest challenges you'll face in your quest to becoming a profitable trader is to maintain the objectivity while trading. If you lose the objectivity, well, that's a big problem. Probably you will not follow the plan, and it will lead to fear. Fear is one of four horsemen of forex trading. Fear will definitely lead you to revenge your trades. Okay? But if you want to build that discipline and try to be objective, trade the strategy for several months or make, let's say, a couple of hundreds of trades, letting the price hit a stop or target which are set at the time the trade is opened. Try to practice it. Try to see what the price does. Maybe you will try to be objective then, saying that it's you who made the mistake. It was not the market. It's more a psychology game than everything else. You need to remain objective. You need to ask yourself a lot of questions. So many questions to be asked. You need to ask yourself, why am I in this trade? Is this a good position? Did I make this position simply because I wanted to revenge my trade, or I made this position because I know that market is going down? Most traders do like this. If they see that market is going up, they will open a long trade here. But suddenly when it goes down, they will open a short trade here. Up, down, long, short, goodbye, Irene, right? We don't have the account anymore. You're dancing a dance of your account. This dance, long, short, we call it the dance macabre. Okay? That is the dance of death. It will lead you to lose your account completely. You are lost, guys. You are totally lost if you start to do that. That's the sign that someone needs to slap you all over your face and tell you, okay, stop doing that. You will ruin your account. You then need to acknowledge that you lost your objectivity. And you need to not just re-evaluate the trade, but every single step of this, including these steps here. You need to avoid feeling lost. If you start to develop the feeling that you're lost, stop trading and accept that loss, guys. Losing, how many times I need to tell you that losing is a part of this business. You cannot end up with every single trade. Guys, even bank traders, they don't win every single trade. We have a good streak on live trading webinars, including session recaps, guys, but it's only like 3, 5, 6, 7 trades, right? What about 100 trades? Don't overtrade. If you make those 5, 6, 7 good trades enough, and you say, thank you, Nana, thank you, Chris. Okay, don't trade if you will feel lost, right? Don't try to be smart, just trying to compete with market. You cannot outsmart the market. You have the arsenal. You have a good account, right? You have, well, at least you put some money into it, real money, right? Why risk it so mindlessly? Don't do that. This is the account, the example. Let's say how revenge trade might give you a false hope. You remember that I said if you revenge your trade and you end up with a winning position, you actually haven't won, because you won just the battle and you will lose the war. Okay, this is the account equity, usually how it looks with it doesn't need to look perfectly as this one, but this is just an example that V-shaped reversals on your account statement can tell you that actually you made up with doubling your risk size, because you know if this has been one trade and this has been streak of trades, definitely this is revenge trades. You increase position, try to recover the recent loss, V-shaped reversal. If your account goes like this, it's okay. But simply put, it's nonsense that you want to trade for a long time just by making double risk size when you lose your trade. This can be 1 or 2 month equity curve, but next month probably it will be like this. That's not okay. And this can be pretty much the trap. You can say, okay, eventually I managed to, well, some people would say probably the end justifies the means. But in Forex trading, we don't have the end that justifies the means. Because once, if you do the end justify the means thing, next time it will be the end of your account. You need to use, guys, your account statements. You even don't need to watch every single of your trade if you don't have the time. Just go print screen and make a screenshot and see how your account curve looks like. And if you identify that most of your wins were actually because you revenge a loss, just stop trading on live account. Take the money, wait until you're sure that you don't make money with revenging your trades, and then you're free to go. And one more slide before I hand over to Chris. Guys, this is how earnings versus time equity looks like. Equity curve or a curve. First, this happens to beginner traders. It's so-called beginner's luck phenomenon. Usually they will start trading, they will, okay, great, I ended up with a nice win, great. Then usually they get slapped by market, and well, definitely what it comes, loss of confidence and money. It will come sooner or later. Then trader starts to cope with a loss in a wrong way, making few revenge trades. Then he manages to deal with some loss, but then again his or her account drops. Then this is a consolidation of skills. It's so-called break-even phase, when trader skips trading on live account, switch to demo account, and try actually a new strategy. Then this new strategy is profitable on demo account. Well, he switches to live account starting from this point, and he is again successful. And then he makes, like, let's say, exponential profits, so-called compounding. The trader is making compounding, sticking to his or her management rules. And then when the equity looks pretty much strong, they will try to adjust earnings to goals and risk profile. Usually when this happens, guys, you lower the risk. I have one of my accounts is in a nice profit. Let's say I think it's like 25-30%. Now I stopped trading that account because that is bigger account, so I'm trading now, let's say, lower accounts. And even though if I lose some from time to time, well, I still have that big account that is, you know, that can cover everything. So that is why I adjust my risk profile, my portfolio, and my earnings. Because if you want to, let's say, fund your account, try to fund your account from profits from some bigger accounts. If you don't have bigger account, then think about this. If you can make a money on $100 account, if you can make 5% on $100 account, you will be able to make 5% on $50,000 account. You just, I mean, 5% is always fixed. 5% is 5%, but the actual money is different. So thank you guys for listening. Now I will hand over to Chris, and I wish you a great day. Tomorrow we will come with new analysis. Thanks for listening, and as I always say, cheers and trade safe.
Thank you so much, Nenad. Excellent stuff on trading psychology. Really enjoyed that. And let me continue now with my part here about trading psychology. I hope you can see the screen. In the meantime, let me just check with the chat box here. So hopefully you see trading psychology, a dartboard and a dart there. It is indeed difficult. At the beginning, you might be able to hit that red spot right in the middle and get the bullseye, as Neda was just showing with the equity curve, that it is sometimes possible to be right on the money at the beginning, have a good streak, but then after we run into some struggle, resistance, and we lose that confidence, and then we start to learn more, and then we realize, hey, it's not that easy, and you bump into all kind of difficulties, right? Regarding risk management perhaps, but especially regarding trading psychology. Trading psychology for beginning traders is not something that you think about. You just trade, you don't even think about that, you don't even know about that. Or at least that's, you know, for a lot of traders, including me, how it went. Typically, you just look at entries, you know, you think it's fun, it's exciting, or you think there could be tons of money to be made very quickly. So typically, you're looking at strategies, entries, not even that much on exits or trade management, maybe a bit of risk management, but it's lopsided to strategies and entries typically. As the experience goes on, most of us have some beginner's luck. Somehow it seems to be Murphy's Law indeed. Not everyone is like that though, but I have a feeling that that happens often indeed. But then you see a turnaround. And then as soon as you kind of like go through the reasons why you see a turnaround, you start to learn more, you start to educate yourself, you start to learn more tools and indicators, and things start to become a bit more confusing, in fact, right? But at the same time, you're learning and growing. So it is a phase that we just have to go through, and there's just no other way to get to that ideal spot that you have confidence, knowledge, and you don't get the results from beginner's luck. So that phase is confusing, though. It does take some time. Unfortunately, that's just how it goes. And then we realize that other things are important too. Amongst others, trading psychology, you start to discover a whole new field, in fact, a whole new area of a topic that you never even thought about, and that is your own psychology when approaching trading, right? Before that, you're kind of like brand new, going right at it, not even thinking about all these things, and then before you know it, fear gets into your trading, you become nervous, just don't have that confidence anymore, and then you read about trading psychology. So a lot of things that are connected to that is about our confidence level, either we're too confident or too insecure, attachment to a trade, and inflexibility towards analyzing and trading the markets, being biased, basically. A lot of things, I think, are connected to this. Then it talks about the four horsemen often enough, and ultimately I think that these three things are at the basis of the fear and the hope and impatience that we bump into when we're trading. So I want to talk a bit about problems and then solutions. I think that, but these three things I think are really about it, about the core of the problems that we typically have. Either we just don't feel confident enough, or too confident, or just very attached to a certain analysis or trade, or we just can't get rid of that bias. Now, some of the conflicts that I think arise when trading is fear of making a decision, fear of being wrong, fear that the market is going to prove us wrong, fear of entering or exiting any particular decision, but fear that we're going to make the wrong one. So what we need, I'll talk about solutions later on. So, but that's one very important one. The view on the market. I'm right. The market should prove me right. Right? The market doesn't have to do anything. The market is like water rushing down the mountain. It doesn't have to do anything that we expect it necessarily to do. We can make our best guess, but it will do what it naturally has to do. And trading is easy. At the beginning, we have a maybe over-romanticized idea about trading, that it's a walk in the park. Many conflicts have to do with the fact that the insecurity, avoiding losses, avoiding pain, like Neda talked about, not having a stop loss. Why? Because we have painful moments with the stop loss. We're maybe not technically sure where to put it, but even if we are, then we just want to avoid losses so much that we don't even want to take a small loss, although that would be smart in the long run. So I wanted to talk about some solutions that I think are important messages to keep an eye on. Instead of being attached to a trade, try this. Try to see your trade idea as a test. You're testing the market. You're just, like you're visually just see yourself as blowing up a balloon, right? And you're putting the balloon in the air, and you're testing how the weather is, or the climate is, right? The balloon could either pop, or it could nicely float up to the ceiling of your room. So when the balloon pops, it has no particular consequence for you as a trader. One trade idea didn't work, so what? Right? Don't take it emotionally. Don't take it as something that reflects on you. Now, all of these solutions, or some of these solutions, might not be an issue for you. Some might be more important than others, right? You have to choose the ones that you think are most appropriate for you. But just don't get over attached to one particular idea, or even a string of ideas, a string of trades, even a strategy in its own right. Even if a strategy doesn't work, the most important is to test it fully, to continue to a point that you say, I've tested the strategy, but it's not for me, because most of the time we just make a very small circle and we give up quickly and move on to the next thing. Now, I'm not saying that improvement is not good, but you need to kind of complete the circle, make at least 40, 50 trades to have a first initial idea about a strategy, and then either continue or not. Eventually you want to push further than that, though. You want to find a strategy where you go and test even more and really make even more trades than that. You can only do that if you don't take the feedback from the market personally. And this is basically very personal. Whenever someone gives you feedback, it's difficult for most of us not to be offended in a way, in a bit, right? Unless you've really trained yourself to be open to feedback and distance yourself from those words, but really, of course, if the feedback is genuine, of course, and fair, it's difficult. Still, even then, it's difficult to, remove yourself from that equation and really get down to the core and understand that feedback and work with it. These trading ideas, you're getting feedback from it. So I think that's why it's so difficult for us to, as humans, handle that feedback. But it's actually great. It's actually moments to learn, improve, and if you just see it as, hey, I tried it, this is an idea, and it didn't work, why not? How can I learn, etc. Or maybe it's just one of those things and you move on. Regarding the market, try to see the market as a place of opportunity. Don't see it as something that's bad, mean. It doesn't help. It is not something that will be constructive for you as a trader. Rather see it as a place that gives you opportunity. a friendly place where you have the ability to capitalize on your ideas. See it as that, as a creative way to find and to find opportunities and participate. Try to see yourself positively as a trader. Try to see the market positively. All right. Try to focus less on entries and strategies. Try to focus more on trading psychology. That you create a positive vision for yourself as a trader. That you see a positive outcome. That you have a goal and dream you're working to. Work on other things that are important, like trade management, exits, and persistent, consistent risk management. Not saying that you shouldn't, pay attention to entries or strategies at all, but don't make it the only thing. Regarding that vision, what I meant basically is, you want to have a critical optimism. You want to be a critical optimist. So you want to be optimistic, but not in a naive way or oversimplistic way. But you don't want to become a cynical trader that thinks nothing goes my way. This will also not work out. Because if you already have that preconceived ideas in your mind, you're going to make self-defeating choices. You're not going to be optimal at your game. You're not going to be present in the moment sufficiently to make the best decisions that are good for you. You're kind of self-sabotaging yourself. If you're in that mood, then it's better to stop, take a break for whatever length you need to get back into this critical, optimistic kind of point of view. So you want to be optimistic, but you don't want to be out of the ballpark optimistic that you become naive in what to expect from a trade or the market either. So it's always that balance. That balance is kind of the red line through all of these topics. Also with confidence. Yet again, find a balanced confidence. It takes time, I know, but you want to find a point where your trading plan and the system you've taken you're confident but not overconfident. And even if you don't feel confident, just try to act that way. All right? Because ultimately, if you're trading demo or and testing the system, or even if you're already further than that and you've tested the system and you're already on live trading, you want to be able to be at a spot before you have a track record for yourself built. You want to take extremely low risk, right, until you have proven to yourself that, okay, I'm able to build a track record and I'm in the long run profitable. So if you're taking low risk, then what is the worst thing that can happen? You have one loss? No, that's not the worst. It's only one loss, maybe a streak of losses. So yeah, drawdowns do occur. So those are things you got to get used to as well. And if you're taking small risk, then that should not really have a major impact on your trading capital. So try to let go of all of that, the fear and emotions connected to it. And when you're in a trade, just practice being moderately confident. Not even looking at the trade. Just practice that. Just don't even, don't even over worry about one particular setup. Use that and just say, okay, this is my idea, this is my plan, I'm just going to stick to that. Stick through it no matter what. This is my plan, and your plan could have trade management options, don't get me wrong, but don't fall into that trap like, oh, this is my plan, but look at the market, and oh, I don't know, I got to exit, right? Just stick and act like as if you have that confidence. And because if you already act that way, then you'll slowly kind of ingrain that new vibe into your trading. Let the market speak, as I say, and try to listen. So instead of having you can have a vision for the market, don't get me wrong. I have that too. I have expectations that are connected to invalidation confirmation levels. I'll talk about that in just a second. But try to be responsive. Try to be open to what the market is saying to us. Often enough, what happens is we make an analysis, we have a bias, and then we close down. That's the problem. We get attached to a particular outlook, and then the new information all is, we have colored pink glasses on. That new information is not honestly reviewed because we have already a bias. We don't have that bias when we start. But after we do analysis, after we go and look at the markets, and we look at our strategy and then look at the markets and see entries, then all of a sudden we're rooting for a team. Up or down. This is problematic because it disables our honesty towards ourselves. We just can't review the markets in the same way anymore. So try to remove that. Try to look at the markets in the same way at the beginning, halfway, at the end. You're always looking for your analysis to be as accurate as we can. That's not always going to be correct or perfect. That's why, and that's okay. It's okay to have a bias as long as we're open to, flexible enough to incorporate new information, that we're honest enough to say, okay, that new information is going to impact me this way, probably this way, or maybe this way. That there are gray areas here as well. But if we're hard-headed and say the market has to go this way, that's when I started, and this is, has to be this way, then we're going to run into some troubles if we're not flexible in the information it provides us. If there are candlestick patterns, for instance, that show that our trade is not going maybe the right way after a while, and we're not flexible enough, then that's going to be difficult. Vision with steps means what I was just talking a while ago about how you want to have a vision and goals. So you want to have a vision, but you want to have clear steps connected to it as well. Regarding this confirmation and validation level, so when I have a analysis, I'm always looking for decision zones. I'm looking for confirmations at those decision zones, bounce or break. I have clear confirmation signals I'm looking for, and invalidation levels where my analysis is out of the window. That's how I keep myself honest. That's how I know when the market is telling me something different is happening, or it is actually happening as I expect. If the market has not reached the decision zone, then I know that I don't want to chase the market. Because if I'm entering halfway a triangle, then it's probably indicating that I am trying to trade a situation, a structure that is not yet ready from my perspective, right? In that case, you analyze the market, you go through your list. It doesn't look ideal, but you have this gut feeling that it's not going to set up in the way that you were hoping for anymore. So you kind of enter late. You know that, but still you don't want to miss that trade. So that's kind of entering in no man's territory, in the middle of nowhere, right? And those are typically not the best entries. They can still work out sometimes, but typically they make you nervous, insecure. I rather wait for price to reach levels that I consider decision zones, either back to a bounce spot or show a breakout, for instance. Then I'd rather wait for price just to finish it being in the middle of nowhere than anticipating something really kind of out of the blue. Rather not anticipate, rather wait for the market to decide and react to that, than take a decision and hope that the market follows me, basically, right? That's my idea. I want the market to lead. If you look at it as a dance, I want it to be the first one to make a move, and I follow along with that, rather than I make the move and hope that the market follows my dance move. It's very much similar to dancing. You want to have the following role as a trader, in my opinion. Now, sometimes thinking one step ahead is not a bad thing, and traders do have success with that. I'm not saying that you can't have any pending orders, for instance, right? It is, I think, more difficult for most beginning and intermediate traders to work with catching a trade that goes against, let's say we're going for a long and the price must be falling, right, before that long is triggered. Otherwise, price will not get to my pending order if it's a buy setup that is below price. So it has to fall, right, to get to my price. So automatically you have price going against you, and you're entering against the market in a way, right? So that is a bit more difficult to understand. What are the key support resistance levels? Where's confluence? That is strong enough for those trades to be taken. You need a bit more experience with that. It's possible to do that, but let's say 61.8 fib, I see there's confluence, I put a pending order there. So in this way, I'm a tad thinking ahead, and I'm a tad kind of like not following the market perhaps, but it's only slightly, because if you have enough experience, you know that the trend is up, for instance. This is a good chance it's retracement. There's a lot of confluence. So I would still say that this is within reason, right? And it's not a very wishy-washy setup. No, you are maybe a half a step ahead of the market, but that's okay because you have a lot of reasons for that, and you have the experience to do it. Risk, just very quickly, the lower risk you take, the less nervous you're going to be, and then you can practice sticking to your trade, sticking to your trading plan. You can practice that, let's say, the acting of being confident, because if you act as you're confident, eventually you're going to become confident. All right? That is a question of time. Try to capitalize, realize that the market itself is emotional, and that the only way to capitalize on the market emotions, is if we're not emotional, and we can avoid emotions. One way is not to marry that vision of the market, not be that biased. Already talked about that. Different solutions could be as well to understand that what type of trader you are, whether you're a strategy trader that can follow those strategy rules, or maybe you're a more discretionary trader that likes to look at patterns, trend, momentum, support, or resistance. When you do trade management, if you choose to do that, because some might go for set and forget, the active management has an advantage is that you can use new information to your advantage, but it takes more, let's say it's a bit more, you need to be more sturdy in your shoes about, got to be more confident about the fact that you don't always change your analysis. Let's say we're taking a trade on a 4-hour chart and we zoom into the 50-minute chart and we see a bearish candle, we get nervous and we exit. That would not be balance updated. That would be nervousness derived from a very small time frame that is not so significant for a 4-hour trade, and that's basically exiting, in most cases, 99% of the cases, I would say, too early based on fear and nervousness. If you're trading on a 4-hour chart, you should probably keep an eye on the 4-hour chart. I mean, in some cases, you might look at an hourly if the trade takes too long, or actually if it goes very well. But typically, there's no sense to look at hourly too often because you only create nervousness, or lower it, because you create nervousness for yourself. You need to find that balance that you give time for a trade most of the time at the beginning. Then you become a bit more demanding. You move it to break even. You give time for the trade to develop to take profit. Once it's in take profit, then you want to become a bit more demanding again. I talked about that in a trade management webinar, so we definitely recommend to take a look at that. That's my ideal way of managing trades, I think, personally. I don't chase trades or anticipate trades too soon. Don't chase it if you think it's already behind. That trade is already gone, away from the train station. Leave it. Let it be. Don't anticipate it too soon. If the candle hasn't closed, for instance, and you're looking for bearish engulfing twins, it looks like an engulfing twin right now, so you jump in it, but then the candle closes and it's not, and it's a bullish candle. Oops. Right? Wow, where did that engulfing twin just disappear, right? That can happen, and if you enter too soon, before the candle's closed, then the candlestick pattern might disappear. That's jumping the gun, as it's called. And whatever you do, try to always make a decision that you can accept afterwards. Try to make decisions that are that you won't regret. So in a certain way, if trying to outsmart the market with each and every single twist and turn is going to just be so tiresome. You might make a few right decisions, but eventually you won't. And then you're going to beat yourself up for the fact that you broke your rules, and it's going to be annoying. You're going to feel it deep in your gut. You're going to be very annoyed with yourself, and you're going to make worse decisions after that if you don't stop trading, actually. And it's going to be a negative spiral. If you can explain to yourself that each of those decisions is according to plan, and even if your plan is not 100% clear on certain decisions, right? Because maybe it's a discretionary call at the time, so you need to make that call right then. You choose a decision at that point, and say it's not optimal. Try to accept it. Try to just be okay with decisions you make, roll along with it, and if you can't be okay with it, then stop. Because that's where the revenge trading, that's where the annoyance trading starts, and that's always risky and often enough doesn't go well. Try to internalize the fact that, okay, think about it a bit more deeply and then internalize it and think about whether that particular decision you make, if you can accept that, even if the unthinkable happens, let's say, or the unexpected happens, and be ready to accept it already. So instead of waiting for the loss or the stop loss to be hit and then dealing with it, then it might be too late, because then you might be already emotional. Try to already pre-advance, be anticipating that, and then thinking to yourself, okay, I made this decision for these and these reasons. They were clear. I'm accepting this decision. And in retrospect, it doesn't mean that in retrospect you can't look back and say, okay, next time I'll do this and this decision a bit better. I'll be a bit more patient with the trade. That's fine. Point is not to get emotional from those decisions. Accepting the decisions goes a long way. You can better accept the decision no matter what, because it's not going to help if you don't. Giving yourself advice rather than trying to find the optimal decision. So if a friend of yours was in that trade, what would you advise to them instead of telling yourself what is the best? Or ask a friend what is their advice, what is their opinion. Because they don't have that emotional attachment. They don't have those pink glasses. So, of course, asking a friend has this kind of disadvantages. You want to find someone that knows your trading style, of course, maybe even has a similar style, so that otherwise you're not going to get an answer, I think, that will help you, because they're not, not into how you're trading. if you could give yourself advice, of course, that's the best, but sometimes it's difficult to remove yourself out of that equation. So, but if possible, that's great, because if you can give yourself advice, then you're not being emotionally attached to it. You can be more honest and more clear about what is really going to happen and what is really more realistic than the hopey kind of idea we might have when we look at the markets. Write that feedback down, definitely always good. And we had in the past very important feedback to learn from it. And we had in the past the trading psychology quiz. You can take a look at that and complete it at advermarkets.com/analytics/tradersblog/review your trading psychology score and more. I guess some of you already have done that because it's from a long time ago. But if you didn't, there it is. And there are, I don't know, 21 questions. And you just get an idea about your current state. And you can do it again a year from now or half a year from now and see how you've developed in the meantime. Questions like, I am nervous when price is near the target of my open trade. And the level of whether you agree. It scares me when price makes many ups and downs. So, you know, I mean, obviously, there are answers that will give a higher trading psychology score, but that's not the point. It's not, the point is not getting a high score or a good score. The point is to get a score that reflects how you currently are in your development. Of course, when you're not nervous, that's better. Of course, if you're not scared when price makes ups and downs, that's better. That's not the point. The point is to be fully honest. The score is for you anyhow, so it's for you to learn and measure, not to impress, of course, me or Nenad with a high score, but that's something I guess you already realize. So I never regret trading decisions, right? I mean, never is a strong word, but the less we regret, the better. It's about acceptance here. That question is about acceptance, right? I think about my closed trades. Better not. I mean, honestly, it's good to move on right away. And if you can accept your losses, your trades, your wins already beforehand, you can move on quicker. Of course, reviewing them after you finish the day is good. That's how we learn. That's how we learn from the feedback. But then forgetting them actually is good, because if we keep those trades in mind, they're going to haunt us the next day. We want to basically accept, do the feedback and learn, close the day, next day start with a realistic, optimistic view. But if we keep those trades in our mind, then we'll have that baggage kind of hanging over our neck, around our neck throughout the day, the next day. And we can't be that fresh, crisp new trader that looks at the market with a critically optimistic view. Because if we keep those trades that annoyed us in our mind, then they're going to impact the next trading day. And they're going to be annoying us. And they're going to be negatively impacting our trading. So, you know, there are questions about entries, confidence, hope, nervousness, risk, market, trade management, following the rules, feedback, everything we talked about here. Well, not everything, but a lot of it at least. All right, so hope to, and if you want, you can share your score, by the way, at the bottom. I thought someone already did, but I think we had to republish it somehow. So yeah, that's it. If you want to join more webinars, if you have questions, of course, feel free to let me know. If you want to join more webinars, go to Education, click on Forex and CFD webinars, and you'll find the new schedule for next week. Looking forward to seeing you there. We'll take a look at the market, Nenad, his recap setups here, and me on Tuesday and Wednesday with intraday trading and breakouts and bounces, and Nenad as well with the live trading session. And the role of the money management next week. So looking forward to that. Appreciate that you joined. I hope that these tips and tricks help you go to your next level of trading. And if you try out some things and you thought that they helped, I mean, we'd definitely appreciate an email from you, a message to say, hey, this really helped me, or you know, these things push me into the right direction. That would be great, because then we get feedback about what tips and tricks work the best for you, and we can also then give better advice in the future. So that would be definitely appreciated. All right, I don't see any questions, so thanks all. Wish you great trading, and talk to you soon. Cheers.